Welcome to Just Think About It with Nadine and Ben. Before we start our conversation, we have two key requests. First, if you're enjoying our podcast, please subscribe via Apple, Spotify, YouTube, or your platform of choice. And second, we appreciate any kind notes as we get started, letting your friends know where to find us. So I was thrilled when we booked our next guest on the podcast calendar. Ruslan Zinurov has been building industrial-grade blockchain infrastructure for years. He also has grown a premier digital asset mining company with a distinct focus on developing North America's largest vertically integrated self-mining platform with a negative carbon footprint. He's the co-founder and CEO of Consensus Technology Group and co-founder of Merkle Standard. Previously, he was the CEO of All Rise Capital and an investment banker at Barclays and banker at JP Morgan Chase. So I love it when we can bring a hard-charging professional on that we also get to call our friends. So welcome, Ruslan.
Thanks, Nadine. Pleasure to be here.
You and I were talking before, and some of our audience is going to be well versed in what you do, but others might be more like me, where I know something, but I do want a better primer than what Google serves up or I read on different sites. So, given that someone as successful as you left a key role in the investment industry to transition to an investor plus operator role, I think you're in a really unique position to bridge these worlds that some people might be coming from, and me as well. So I'd love to start first on the vertically integrated digital asset mining company that you worked on. And so what does it mean to be vertically integrated? Can we focus there first and can explain it to people so we can build up from the ground?
Yeah, absolutely. So, Merkle Standard was founded in 2021, and the meaning behind vertically integrated company is basically that the company owns both the Bitcoin mining equipment as well as the data center infrastructure. So it's end-to-end producer of Bitcoin. So we've built close to 140 megawatts of data center capacity between 21 and 22, and our revenue were denominated in Bitcoin, so to speak. So we own the machines, and we also own the data center infrastructure behind it.
And when you were thinking about the facilities aspect of it, what were you looking for? Because that's obviously different just to be a miner versus to be an asset operator and owner.
Yeah, it's a great question. Bitcoin mining is highly sensitive to power prices. So typically, when you see at the Bitcoin mining landscape around the country, you'll see that a lot of Bitcoin mining data centers are actually located in very remote areas where we can take advantage of lower power prices versus larger metropolitan areas like LA, Chicago, New York. And therefore, we are looking actively for sites in remote locations. And as you will see on the map of the Bitcoin mining industry in the US specifically, there are a lot of data centers located in Texas. There are a lot of data centers located in the Midwestern part of the United States. At Consensus Technology Group, we operate data centers in North Dakota, South Dakota, Pennsylvania. We're also building a data center in Missouri right now. So as you can sense, this is very much far from main cities in the US, and that's being a function of lower power prices in those areas.
And we're sticking still on the vertically integrated mining company. Power, obviously, access to power, very important. Maybe talk a little bit about labor and tech requirements. So, are machines very expensive? I know they were years ago. Did it get better? When you break down what it costs to do something like that, where are most of the costs at from a fixed base and then a variable base?
Yeah, so I'll use Consensus Technology Group, our current company, as an example. So we are a pure play co-location provider. So we don't do any self-mining ourselves. We build data center capacity and deliver that capacity to large scale, industrial scale Bitcoin mining customers, specifically some of the OEMs, as well as some of the largest financial sponsors who have exposure to the Bitcoin mining industry. It is still a very capital intensive business, as you can imagine. We need to build the facility, which implies having the electrical infrastructure, which implies having the actual data center facility. In many cases, our data centers are actually modular and containerized,
Hmm.
so which is a big difference between the conventional data center industry and our industry. And the biggest focus for Bitcoin miners is to be cost efficient, both on the CapEx side of things as well as OpEx. And given that Bitcoin mining is not as mission critical type of a compute load versus conventional load that hyperscalers or some of the technology companies have, we can build our data centers a lot cheaper because we're not required to bring all the redundancies like the backup power generation, for example, or some of the networking redundancies that conventional players have. To give you a perspective, our cost of construction for data centers within the Bitcoin mining industry is probably orders of magnitude about 10x cheaper versus a tier three hyperscale location. So this is, we're laser focused on power costs, we're laser focused on capex required to
Hmm.
develop the data center facility, and ultimately it's opex as well. And as you can imagine, our staffing costs are typically also lower given the geographies where we operate.
So, Ruslan, I hear you talking about putting data centers in different places and then with the idea of where the cheap power is. Can you talk to why the major data centers are all located in Virginia, and is there why the advantage is there versus in a more disparate location such as you're going after?
Yeah, it's a great question. One of the biggest reasons why, the conventional providers are located in, let's say, certain areas like Silicon Valley or Northern Virginia is because of the proximity to the fiber lines. The conventional quote unquote cloud load is exceptionally sensitive to latency. That's why you want to be very close to the major fiber routes. Now, there's an argument to be made that perhaps high performance computing, like AI computing, is less latency sensitive because you don't need, essentially some sort of inference type of a load for model training. So you can outsource those model training operations into more remote areas where you train the model and then you ship the model closer to the ultimate consumer of that compute. And that's a trend we're seeing right now where, if you look at the map of, hyperscalers, the Microsofts, Googles of the world, they're now starting to shift in more of remote locations for a couple of reasons. One, the load is less latency sensitive. And two, it's virtually impossible to find readily available power at scale near larger metropolitan areas. So that's why you see that trend where, the big players, they're now announcing hundreds of megawatts or many times gigawatt type of campuses in Midwest, for example.
Right. And so the really heavy duty, uh, compute, which is Bitcoin mining, which kind of brute force, and then some of these AI models, which are a little bit brute force. You're saying, okay, get the cost down to as low as possible for that part of it, and then when you need it for the consumer, so that you have the best operation, that's when you'll move it over. And you're seeing that all over the industry, like both sides, both Bitcoin mining and as well as just the hyperscalers in general.
Yeah, Bitcoin miners historically have been operating in the remote areas as a function of lower power cost. So, for example, it's almost not feasible to operate a Bitcoin mining company if your power cost is above $50 per megawatt hour. This is just the reality of economics of this business. But for cloud business, it's not really a factor today because the margins on the other side of that industry are so much higher than that power is sort of a rounding error in many cases for the total cost of operations.
Right.
But as we're seeing today, given that there's certain projections for the size and growth of the data center industry globally, like we need to deliver close to 20 to 30 gigawatts of additional power capacity to serve the AI load, you're basically doubling the size of the data center industry in a very short period of time, like 5 years. You just have to be now cognizant of the underlying price of commodity, the power cost, because at that scale, it become more sensitive for your business model.
Yeah, we had a guy on here. It was my friend who trades physical power, actually, and we had some of these discussions about it. And we talked about some of the constraints on that build out, and that he was skeptical that it would be able to get to those numbers that are being projected, as you just said, kind of 30 gigawatts. Like, do you see any of that in what you're doing, or is that kind of more on the larger scale ones?
Yeah, I think it's a combination of both. When we talk to the hyperscalers, the minimum size of their operation is now hundreds of megawatts. So they're not interested in 20, 30 megawatt sites anymore. They're looking for large scale operations, which would be prudent from the economies of scale. Because you essentially, when you develop a large scale campus in quote unquote middle of nowhere, you also have to bring enough talent. You need to hire people. You need to find residential resources, right, to accommodate that workforce. Um, so we're seeing interest in larger sites from the hyperscaler operators. Now for Bitcoin mining, it's more fragmented. It's still feasible to run a 10 megawatt site as a standalone facility. Although our preference today, like the smallest site we operate, is 30 megawatts. But the general direction is also to have larger facilities because of the operating cost implications. So I think that's one of the trends we're seeing. It's the size of the demand for sites is now much bigger than it used to be.
Can you put in perspective, one of the numbers you had quoted to me is like a 5x power dense and intense type of difference. Maybe walk through what does that mean for people who like hear the word but don't understand it maybe completely.
Yeah, so if we were to compare apples to apples power density between Bitcoin mining operation and let's say conventional cloud operation, and we'll use air cooling form factor as a common denominator here, a typical cloud density per rack for a cloud provider is about 12 kilowatts, 10 to 12 kilowatts. Our air-cooled operations are close to 70 kilowatts per rack for the same physical footprint. And this is just on air using air-cooled form factor. Now, if we go to a direct-to-chip cooling or immersion cooling technology which Bitcoin miners have been using, since probably 2018 or so, you'll see an incremental step up in power density. So from that perspective, we're a lot more power dense. We don't need a lot of additional space at the data center versus conventional providers. So we can just pack a lot more power into the same square foot.
Okay.
With that being said, the HPC industry, the high performance computing, which is primarily running GPU servers, is now becoming also very power dense and power hungry. This is something very interesting for us, the Bitcoin miners, to observe, because we've experienced this before and we understand the challenges that come with this type of power density. Imagine packing 100,000 of microwaves in a building. That's a massive power load. It's
Right.
not it's like a small town essentially. It's
Yeah.
100 megawatts. And all of a sudden, there's additional nuances here around just physical safety.
Yeah.
It's just immense amount of power. You have your typically you have your own proprietary substation attached to your data center. So there's a clear convergence happening as it relates to power density between the Bitcoin mining form factors and the HPC form factors.
It's kind of interesting. Before we'll come back to this, I want to put a note, put a pin, sorry, where we're at right now. But from like an electrical standpoint, I mean, is it special talent to get that done? Do you need special security for people? Because obviously, it's a very important facility that you're building. with particular needs and probably particular type of equipment. Maybe walk through a little bit about just the building itself and what does it take to build one of these things?
Yeah, so we're all familiar with the sort of conventional data center tier tier terminology, right? So there's tier one, tier
Sure.
three, tier four, tier two facilities. Our data centers, and we have, as an industry, we have coined this terminology as tier zero. So this is below in terms of redundancy, in terms of how robust, how cool it looks, type of a data center operation. And the main reason for that is, as noted, our load is less mission critical. We can actually go dark for an extended period of time, for hours or maybe sometimes days, and it's fine. The only impact on us is the financial impact. So we just lose the revenue associated with that uptime.
Yeah.
If you look at, Facebook or Boeing, their data centers cannot go dark even for a minute because it is mission critical. It's it could be a catastrophic outcomes from this type of downtime. So we don't have to build robust data centers. We build it optimized for cost and operations and certain uptime metrics. So our cost of development is in many cases 10 times cheaper than a tier 3 analog.
Okay.
Does that allow you to have different fuel sources? Like what is the most what are you using for your power on the gen side?
Yeah, so all of our data centers are connected to the broader grid, and depending on the region, it's really hard to tell where exactly that particular electron is coming from. So we typically reference broader mix for that particular region or for that particular utility company. And in many cases, it's a combination of renewable energy like wind, solar, and many times hydro, as well as natural gas, and in certain areas there's still a small portion of coal. But again, it's sort of a broader mix. So we're not different from another consumer of power in that particular region because we're subject to the broader grid fuel mix.
So you're not connecting right like to the plants like some of these guys who are co-locating are.
Yeah, we don't have any behind the meter type of operations just yet. Although there were quite a few precedents where Bitcoin miners a um, become a tenant at specifically some sort of renewable generation, and the reason for that is Bitcoin mining is arguably the only large scale interruptible load you can find, as a customer. Again, we can go dark. So for example, if a particular utility or a particular grid region needs us to go dark, they would just send us a signal and we would curtail for a period of time. It could be hours. So this is a benefit to the grid because we provide a base load which could go dark for a period of time. So and the utility companies like this because we're the only ones who can do it at a scale of hundreds of megawatts, where an aluminum smelter is virtually impossible for an aluminum smelter to go dark. It's impossible for Amazon data center to go dark. So what do you have? You have this Bitcoin mining operator who we get calls all the time, with some requests to curtail our operations, and this is the benefit to the broader grid and to the communities which we operate in.
And do they pay you, or what's the economics to that?
Yeah, so typically, there's certain demand response programs available for each utility because they recognize the benefit that we bring to the table, and as part of that demand response program participation, we typically get some certain benefits on fee waivers or even reduction in the commodity energy prices.
You're basically in a situation where these guys are coming to you, and do you have a sense of where the cost of production is or what the range of the cost of production is right now in terms of what kind of Bitcoin price they need to be profitable?
Yeah, this is a very interesting question, Ben. So Bitcoin mining profitability is a function of a few factors. And I call it a three-dimensional chess because it's not just oil and gas where, you sort of, if you operate your own well, you kind of know your cost of operation. You kind of know what the commodity price is in the market, and you can project or hedge that commodity price, and you know what your OpEx is. With Bitcoin mining is a little bit different because the total supply, the total revenue for the industry, so to speak, in Bitcoin terms is fixed. So it doesn't matter how many operators are there at a particular point of time, how many servers are mining Bitcoin, your revenue is still fixed at a, you know, at a number of Bitcoin per day or per minute per block. So you're competing against the same revenue. And that's one of the factors in our economics or our customers' economics. The other factor is obviously the price of the Bitcoin commodity, which fluctuates. So there's a component of volatility in that part of the sort of top line revenue. And then ultimately, it's your own cost of operations, right? How well can you continue operating, including what kind of power cost can you negotiate with the utility companies? So to answer your question about sort of the Bitcoin price that is break even, it also depends on the type of equipment that you run as a Bitcoin miner, because certain types of equipment could be more energy efficient, so you're not consuming as much power from the grid for a unit of Bitcoin mining revenue. So it really depends, but I would say maybe as a sort of average benchmark, for the industry, it's still roughly a 30% gross margin business. So Bitcoin price today is 55. I would say, probably 35 to 40,000 is the average cost today for the industry.
Is there a risk of capital misallocation? If you think about I'm very familiar with the underlying dynamics of, hey, we're gonna cut the amount of Bitcoin you get for mining, and then price goes up, so it's kind of algorithmically priced to go up. But is there a point where, like, if dollars don't flow in, as somewhat they've stopped, not stopped, but very much slowed recently, that then you have to just see the only other way for the lever to work is guys go out of business? Is that you see like that starting to happen at all?
It's very reminiscent of oil and gas industry from the capex perspective, because you have to invest capex today, but it's going to take time to build a data center. It's going to take time for your equipment to be delivered. So if you invest $1 today, you will likely start generating returns, revenue on that investment probably a year later. But a lot of things can change in that year.
Mm-hmm.
And we've seen this in the other commodity industries like oil and gas, where the price of oil is high, so a lot of capex is flowing in, and then all of a sudden a year later, the price of oil crashes, and then you have all of that excess generation capacity out there, and you can't really shut down the well, so you're forced to produce, and therefore your gross margin becomes many times equal to zero or go negative, but you can't really stop. There's a difference with Bitcoin miners because it's actually easy for us to stop if it becomes no longer marginally profitable to mine Bitcoin, because we can just go dark. We can just unplug the equipment. So it really depends on the type of equipment that you're running. Typically, the most energy efficient equipment is the last man standing. And those miners who operate the latest generation equipment, they survive. That's a big nuance in our industry vis-a-vis maybe other commodity industries that you're seeing out there.
And I remember a few years ago, you were trying to get your hands on a lot of computing power. Is it still a bottleneck, or is that not the issue anymore? Are there other issues in terms of the equipment?
Um, it's no longer a bottleneck, I would say today, and one of the reasons for that is, Bitcoin mining profitability today is not as robust as it used to be, let's say, at the end of 2021.
Right.
And 2021 is an outlier, primarily because of the China
Yeah.
mining ban, where essentially half of the industry had to go dark. And as you may recall, the revenue is fixed. So all of that additional incremental revenue became available to miners outside of China.
Yeah.
So the profitability of mining was through the roof. Like, for example, a lot of players were underwriting a 3-month payback
Wow.
on your investment. Today, it's probably more of a 2-year type of paybacks, which is, pretty standard for the industry. So the equipment is available. The industry from the equipment side is basically a duopoly today. There's a couple players. Bitmain is the juggernaut. They likely control a lion's share of the industry, and there's MicroBT, which is a smaller player. But yeah, you can buy equipment today.
Can we run the unit economics of that? Like, how long do these chips last and the equipment last? Like, what's the useful life on them? So if you have a 2-year payback period, how many years of profits are you going to get before it goes down? And I guess unlike oil and gas equipment, where you can probably keep using it, there is a risk if you go down because the price goes down and you're not using it, and then new technology, more efficiency, faster chips, it's still going to deplete whether you use it or not, right?
Correct. Ben, this is a phenomenal point that you're making here. So there are two ways to look at the life and durability of the equipment. One is physical life, which is typically around 4 years. That's how long the machines physically last, because they operate 24/7, many times in a very harsh environments, with dust, with snow, with all the environmental factors. And there's a more important, in my view, metric here, which is economic viability and economic lifetime of that equipment. As Ben, as you've noted, the industry is constantly improving in terms of energy efficiency, and the new equipment comes out every year. So you absolutely have to um, you know have your equipment operational, otherwise it just becomes obsolete. So if you put it in the warehouse for a year, it's going to be no longer that much profitable versus today. That's one thing. And there's also another concept I would layer in here, which is called halving, which you may have heard about. And basically, it's a concept embedded into the Bitcoin mining mechanism, where every 4 years, the total revenue denominated in Bitcoin for the industry goes down in half. And the most recent halving happened in April of this year. So you're really, really incentivized, and you have to be exceptionally careful to deploy that equipment into your data center right away the moment you get it. So that's a great point, Ben, and been one of the main areas of focus for the industry.
So do you find that's why you're actually gaining share in the marketplace, because you're able to let these guys have flexibility, but then also another cost driver down and it's really just a race to the bottom because they're a commodity player, I guess?
Yes, and infrastructure is the foundation. Data center infrastructure is the foundation of the Bitcoin mining industry. You can't operate your equipment. It doesn't matter how profitable or energy efficient it is or bleeding edge it is. You still have to have a data center to have it and operate it. So this is our role in the industry. We deliver large-scale industrial-grade Bitcoin mining data center facilities to our customers, to our institutional customers. And we have very well-established reputation within the industry, and a lot of customers trust us and give us a ton of business. So that's where we are, and we are very proud of what we have accomplished to date with our team and our operations across the country.
And when you think about, looking ahead the next 3, 5, 10, 20 years, obviously now that you have a background in investment, in operation, in crypto, where and with AI now changing, or I guess altering the potential use and economics of different types of build outs, where are you seeing the opportunities today in infrastructure? So, coming in, if you're somebody thinking about investing in there, because so many people have been talking about, and loading up on money to invest in this space, like where is it most interesting and why? And can anyone do it, or what kind of skill sets or expertise is required to play in the areas that you think are most interesting?
Yeah, AI is most definitely a phenomenal industry, and it's not going away. There's just the velocity of growth and demand for power coming from AI is absolutely incredible. I've never seen anything like this before. I mean, we're talking about gigawatts of power that the industry is in need today,
And
right? And this
is that
is
like from what you read, or people contacting you and wanting, like, is it demand driven, that statement, or is it, news driven, that statement?
yeah, this is actually firsthand experience because we get a lot of inbounds from, hyperscalers essentially asking us a question to sell or convert our existing power infrastructure
Yeah.
for HPC use case.
Okay.
And one of the reasons for that is they just simply cannot find readily available power today because NVIDIA is still continuing to print chips.
Yeah.
You can't really sit on them in the warehouse. You have to deploy them. There's a ton of demand coming from the AI companies for high performance compute power, and that's driving sort of the thesis, and we call it BTC to HPC,
Okay.
where we estimate that the Bitcoin mining industry in the US is close to 10 gigawatts
Uh-huh.
of power capacity. So this is a potentially a 10 gigawatt chunk that could be available for hyperscalers. Now it comes down to economics, right?
Right.
Everyone
Everyone
is
wants a piece
arguably
now of this, and so who's in the power
right,
seat here?
right, right,
No
exactly,
pun intended in that.
right. So it's a very interesting dynamic where both industries are very power hungry. There's just no transmission available at that scale or incremental transmission. No, there's no incremental generation available at that scale. So what do? You have to kind of start looking at the quote unquote younger brothers, right, and see if you can take away
Yeah.
some things, from them.
Yeah.
And Bitcoin mining is one of the most definitely targets, and you see quite a few announcements from even the publicly traded Bitcoin mining companies who are now considering a pivot into HPC just because of the readily available power that they have.
Right.
Yeah, because that same guy that was trading power, I was talking to him and I told him you were coming on. He's like, ask him how many guys are making more money from Bitcoin than just selling power. So it was like right there with you on that. Do you think, how do we think about the value of a Bitcoin miner? Okay, so other than the inventory that they hold, so independent of that, but just as an operational business, okay, we have 4 years useful life, capex, like how would it, explain that to our listeners, because we have these publicly traded Bitcoin miners. How do you think about it as a former, been in the industry for a while?
So academically, you would look at a Bitcoin miner's valuation as net present value, discounted value of the future cash flows, right? I think that's a sort of a fundamental approach to valuing a company. And then you have to have a certain sets of assumptions around where the Bitcoin price goes, where hash rate, which is the difficulty of the Bitcoin mining industry, is, because as more Bitcoin mining compute comes online, your share of the market becomes smaller, and as I've noted before, your revenue is fixed. So there are more miners competing for the same revenue. So you really have to have a good view on the hash rate projections, which is one of the fundamentals here as it relates to the profitability of the industry. And then ultimately, the third factor here is the amount of capital that is available to Bitcoin miners because you constantly have to refresh your equipment. You have to invest into retrofitting your data centers or buy more data centers. Capital markets is a huge consideration, just given how capital intensive the industry is. Another way to think about it is some of the parts, right? Because you've got tangible infrastructure, which is the power, the substations, the actual data centers, the pad mount transformers, the wires, the permits, the land, everything that goes into a Bitcoin mining data center. And then you've got the actual operational business, which is the Bitcoin miners. And you just have to have a view, as noted before, on Bitcoin price and hash rate and your power cost.
And when you were in that business, I mean, did you have teams of people, or how were you forecasting the price of Bitcoin?
It's impossible. It's just impossible. I mean, a lot of people tried. Like, you can have the most robust Excel spreadsheet in the world. I can tell you it's going to be 100% wrong. And you probably have to have a directional view and really have a good understanding of what's happening behind the scenes for the industry. So, for example, this year was a very interesting one, especially at the beginning of the year. One of the major tailwinds for Bitcoin or digital assets in general was the approval of the ETF.
Right.
Now, that removed a humongous risk of essentially U.S. government, so to speak, banning Bitcoin. Now it's going to be really hard when you have retail investors in those ETFs, where you have pension funds now having exposure there. So the industry just took that signal, that's powerful signal, that it's okay now. It's no longer in the doghouse. It's no longer a means for criminals to do money laundering. It's an asset class. You go to CNBC.com, you go to Bloomberg, you see equities, you see interest rates, you see oil and gas, and now you see crypto as one of the adopted asset classes. So that's a major factor here. Another factor here is halving, and the fact that there's a fixed amount of Bitcoin available over the next until 2140, right? It's 21 million Bitcoin. So it's a very much scarce commodity, so people really, investors really value that component of that asset class versus, for example, U.S. dollar, which is, which will be inflationary going forward, undoubtedly. Yeah, I think that's, there's an argument to be made that, Bitcoin should be an ultimate sort of store of value or an analog of gold, which investors should flee to, and when the times are hard. It's still not
right.
It's still not even close to that. It's still very much correlated to let's say technology equities.
Also, the more that you have into passive ETFs like that, the more it's going to be volatile, right? Because flows come in, flows come out. So it's hard to say it's a store of value. It seems like you have to understand the use cases and the relative sizes. Like, if there's countries that are going to be using it to trade with each other, that's different, right, than ETF flows.
Right. So this was a long way to answer that. It's impossible, in my view, to predict price of Bitcoin. You just have to have maybe certain scenarios and sensitivities in your model, based on that.
Can I ask you a question about that? Because I hear this meme about the fixed supply, but we've had a number of forks in the history of Bitcoin, and there's lots of little ones, but there's three major ones. And also, how does the Bitcoin network be secured in 100 years? Now, it doesn't matter for us today because we'll all be gone, so that's why the effectiveness of the meme. But like, transaction costs will have to go through the roof in order to secure the network, right? Or how else will miners make any money if they're not having the subsidy? Can you talk to that a little?
Yeah, after 2140, the only revenue that Bitcoin miners will be getting will be coming from transaction fees, because there's going to be no more quote unquote new Bitcoin available to Bitcoin miners. Directionally, transaction fees, as Bitcoin blockchain gets adopted outside of its current current sort of perception, which is store of value or speculative asset. There's been a few developments to try to adopt the Bitcoin mining blockchain for maybe transactional use cases. There's Lightning Network, there's the certain NFTs and other products being developed on top of Bitcoin. And Bitcoin being the most secure, it's backed by tens of gigawatts, at a minimum of power capacity sitting behind it every single second. So it's virtually impossible. At least there are no cases or precedent of the Bitcoin blockchain being hacked to date. So which is a massive value add that Bitcoin brings to the table vis-a-vis other networks that could be centralized. Bitcoin is decentralized. So the investors and the community believes in Bitcoin and trusts Bitcoin blockchain. So at some point, I would not be surprised to see additional use cases being developed on top of layer one, being Bitcoin.
Right, the layer twos, and then people transact on the layer twos, and then it just becomes a settlement layer. I'm familiar. But what about the other risk, which is the quantum computing risk? I've seen Google's quantum computer, and this is a little above my pay grade, but from what I understand is that if quantum computing advances, that it can break the cryptology of Bitcoin. Could that be a major risk that you ever think about?
Theoretically, yes. If someone is able to develop a stable quantum computing server that is orders of magnitude more powerful versus conventional compute, there's a case to be made that it could just essentially take over 51% of the hash rate and in theory rewrite the blockchain and all the transactions on it, which will destroy proof of work networks like Bitcoin. But we've been exploring sort of the threat or the potential of quantum computing for quite some time. And I remember still being a banker in 2017, where we've spent a lot of time researching quantum computing. To my knowledge, we're still quite far from that. And I would imagine that at some point of time, the OEMs would likely embrace quantum computing and maybe incorporate this into the proof of work algorithm somehow.
That's
But
interesting.
for now, I don't see this as a viable risk at that particular point of time. But academically, I think we all agree that it could be. But at the same time, look, if quantum computing is able to quote unquote hack SHA-256, which is the algorithm behind Bitcoin, like forget about your online banking, forget
Yeah,
about
yeah, yeah, yeah,
your Gmail,
yeah.
because they're using exactly the same cryptography behind it. It's probably going to be lesser of a problems than we're going to be facing here.
Right, because it's funny with the good power guy. We talked about a Carrington event happening, and that was like another risk for the Bitcoin. But to your point, I guess if that happens, there's a lot bigger problems that we need to worry about.
And from a public market investor perspective, if there's many folks out there who are either feel late to the game or don't understand or trying to figure out where to spend their time to understand where the puck is going, are there areas of potential investment in the public markets that you think that people should be looking at, whether it's in utilities or industrials, technology, or other, maybe just crypto itself, but are there any areas that you think about? I know your day job's different. You're not doing that anymore, maybe just with your own personal money, but are there any places that you would point to for people where they should focus their time and maybe sharpen pencils a bit?
Yeah, it's a great question. And Nadine, let me bifurcate maybe my response here. As we think about AI, and which has a massive demand for power and for data center capacity, I think it's worth looking into maybe the supply chain,
Mm-hmm.
specifically on the data center side of things. So, for example, direct to chip vendors, certain producers, manufacturers of substations, of electrical infrastructure, because you can't really, um, build anything without the actual underlying, the
Right.
fundamental supply chain for that. I'm not going to take a view on, current valuation of certain, chip companies or AI companies. It's just not
Not where you sit. Yeah.
exactly. I would, most definitely look into the infrastructure side of things, because I know that for a fact the demand is so enormous that those companies will be the ultimate beneficiaries of this growth. Now, as it relates to Bitcoin mining, it's
Tough slog there, or what do you think?
correct. Let me. I would encourage investors to really do their homework.
There you go. Well said.
On
Well said.
right. This and I know many of the Bitcoin mining is a relatively small industry, so I think I have a decent understanding of the capabilities of certain players, but there's been a lot of talk happening on the pivot. On a lot of Bitcoin publicly traded Bitcoin miners, in my view, are still kind of looking and searching for their actual identity,
Right.
whether they are an AI play or still a Bitcoin mining play. And there's nothing wrong with being a hybrid, by the way. Yeah, it's worth double clicking on maybe some of the filings.
And are you just focused in the US, or do you think about, facilities and use cases outside the US too?
Yeah, we've looked at other geographies. Yeah, typically you find cheap power in emerging
Sure.
economies, versus, for example, it's virtually impossible to do any kind of mining in Europe,
Yeah,
just
I
because of the
understand. You're
power.
not in London. Yeah.
Right, right. Or even, some of the northern, countries in Europe, like Norway and
Yeah.
Sweden, which used to be a destination for Bitcoin miners. That's no longer the case. So you're forced to go into the emerging economies, and now you're facing some of the geopolitical
Sure.
risks or country-specific risks. So we were just not comfortable with that type of a strategy. So
Yeah.
we're solely focused on the U.S., given the power prices are still very much competitive against the rest of the world. The electrical infrastructure and the grid is very robust, and probably the most robust system out there.
Mhm.
So it's really important for us to focus on those factors.
And so as we go forward with this power demand side being so robust, driven by data centers, driven a little bit by industrialization, some of the reshoring stuff, and obviously crypto. Um, do you have a view on where that will be met? I know we know some of the constraints from the power gen side are the transformation or transformers, but where do you think, like, how do you see it evolving, both from the source fuel or it could be just solar, so it doesn't have to be that fuel, and then where geographically you think it will evolve to, or do you think it'll just be as is? That's a fine answer as well.
Yeah, in terms of geography, I think the trend, sort of this tectonic shift away from the Northern Virginia and Silicon Valley towards the middle of the country is going to continue, in my view, because it's just a lot more feasible and a lot easier and faster to find power and power generation for that matter. So I think that's definitely a trend that will continue, and especially given that the training loads are less latency sensitive. So we're seeing that right now. As it relates to generation, we're seeing convergence of generation in data centers. As you may have seen, I think back in May, Brookfield and Microsoft announced a partnership where Microsoft is investing $10 billion into Brookfield to essentially fund the build outs of generation of renewable generation for their data centers. And one of the reasons for that is, they simply cannot find enough power. I think the trend with the renewable will continue. Um, but I think fossil will still be the backbone in many states still, because it's just faster and sometimes cheaper to develop that.
Listen, I know that we are coming up on an hour and you have a deadline, so we could spend more hours with you. I know because we have in the past. So thank you so much for sharing your wisdom and experience with us today. And if people want to reach out to you, what's the best way to do that?
Probably my LinkedIn is the best way. So
Ben's gonna
it's
love that.
Ruslan. Yeah, Ruslan Zinurov. I'm pretty responsive on LinkedIn all the time, so I think that's the best way to get a hold of me.
And if they want to know what you're up to, is that also the best way? Do you have any, publications or news that you put out there, or is it really you're so in the weeds doing what you do that you're not communicating it as much?
Yeah, we're heads down. There's so much to do on the construction side that we, at this point, not very active in terms of kind of the broader outreach. It's all about executing and building and delivering capacity to our customers.
Well, we'd love to have you on maybe in like 3 to 6 months to see what you've built out and any changes in your forecast of demand and supply and the major trends. So thank you so much, Ruslan, for joining us today.
My
Thanks,
pleasure.
buddy.
Thank you so much, Nadine. Thank you so much, Ben.
Thank you.